A new law signed today by President Biden is going to affect how you can save in your IRA or 401k. This was known as Secure 2.0. It got snuck in as part of the Omnibus bill that was just made effective today. Now, the changes are drastic. There are so many changes here. But the good news is most of them benefit people saving in their IRA or 401k. So I'm going to outline the greatest hits, in my opinion, that's going to affect you as an individual with your IRA or 401k. Now, these are awesome. Many of them I've been waiting for years. I've helped work on some of these myself particularly. So let's hit them. First, SEP and simple IRAs can now be Roth. Traditionally, simple and SEP IRAs had to be traditional dollars, meaning they were tax deductible, they grew and came out, and you paid tax on the way out. But now, under the new bill that just went into effect, you can have a simple Roth IRA. You can have a SEP Roth IRA. Under this provision, you don't get a tax deduction when you put them in, but like Roth funds, it's going to grow and come out tax-free. That is huge. Frankly, it's one of the reasons I never liked simple IRAs is because you don't have the option of being traditional. Simple IRAs are going to be a great option for small businesses now, something I'm even considering offering here at Directed IRA now. Simple Roth IRA is going to be an awesome option. And of course, SEP IRAs have been around for a long time for self-employed people, but got a knock from me because you couldn't do Roth. Well, they fixed that. Now you can do Roth accounts. And this is a huge part of the bill. More Roth options. Congress loves the Roth option. They want to give us more of the Roth option. Why do they love it? Because it helps the budget today. They get more people to save in a Roth. That means they don't give up tax deductions today. If they don't give up tax deductions today, that means more revenue for the government that Congress gets to spend. So whatever the politics work out, win for us, win for Congress, more Roth accounts. Okay, let me hit another one that is huge for Roth accounts. If you have a 401k, even if you solo 401k owners, when you do your employer or the match sometimes, that used to be traditional only. There was no other option. You had to do traditional dollars for the employer match. Now, the employer match can be Roth. You can choose Roth. So you could always do Roth on the employee side if your plan allowed for it. But now under the new law, you can also do Roth on the employer match. That is awesome. Also allowing those that love Roth, like us, to do more Roth dollars. Now we can do Roth on the employee, and under this new bill, we can do Roth on the employer match, on all the employer dollars. Again, more Roth options, being able to grow and get that money to come out tax-free. Now here's another one for sticking with the Roth 401k concept, and this is solo 401k owners too. This is a really cool one. No RMD on your Roth 401k. RMD, required minimum distribution, is the age when you hit 72, which changes here in a minute, but hang with me here, okay? RMD says you have to start taking money out of your traditional IRA, your traditional 401k, and used to be your Roth 401k. You had to start taking money out of this and depleting the account once you hit 72. Now, Roth IRAs had no RMD. There was no required minimum distribution. Congress didn't care. Why didn't they care? Because, well, the money comes out of your Roth and they don't get tax revenue anyways. So what do they care? Well, there was this little quirk in the law that said, yeah, but Roth 401ks, you have to start pulling the money out, even when you hit 72. Well, that has now changed. Roth 401k accounts are also exempt from RMD now starting in 2023, just like your Roth IRAs. So that's awesome, again, for the lovers of Roth accounts. Build it up in your 401k. Solo 401k doesn't matter. No RMD on your Roth 401k funds. Now, speaking of RMD, the RMD age used to be 70 and a half. It went up to 72 back in 2019. And now it's going to 73 in 2023. And then it's going to go up to 75 by year 2033. So RMD age is shifting here. Again, RMD is the date when you have to start taking money out of your account. When you hit that age, you got to start taking money out of that account. Now remember, under this new bill, this only applies to your traditional IRAs and traditional 401ks. Roth accounts are exempt from RMD at any age, so you don't need to worry about it if you've done Roth IRA or Roth 401k now under this new bill. But for those of you that have traditional funds, you're getting more time. Life expectancy is increasing, so the government's giving us more time before we're forced to start taking money out. Now, you can always take the money out if you have traditional funds or Roth funds for that matter once you hit 59 and a half, but there's no force out where you're we have to start taking money out of your traditional account. Now we're moving to 73 in 2023, and then it's going to hit up to 75 by 2033. Okay, now back on the Roth, because this bill has so much good Roth stuff in it. Unused 529 plan funds can be rolled to Roth IRAs. That's right. Unused 529 plans can be rolled to the Roth IRA of the beneficiary the 529 plan was set up for. So if you set up a 529 plan for your kid, they went to college, or maybe they did in the vocational school, they didn't use the 529, or there's a piece left over, you can actually roll that into a Roth IRA in their name. Now, there's some rules on this. You have to have had the account for 15 years, so it can't be something you like set up right now when they're in high school and drop right back out after college. You would have had to have this for a while, or maintain it after college, and maybe they don't end up going to school in their 20s and 30s or more, graduate education, whatever. So the 529 gets unused. Well, it can be rolled to the Roth IRA. Now, it's a max of $35,000. This is a cool option that, again, is going to let more dollars get into Roth. And these unused 529 plan funds are a great place because, let's face it, some people really save in the 529 plans, and then they end up with these extra funds at the end of the day. And, sometimes you can use the 529 for another kid or other family member. And so it is portable where you can move it around to other people. But there are instances where people just are like, well, I don't have anywhere to use it. So they end up having to distribute it and pay tax. Nice option now, can go over to a Roth IRA. But there's more here, okay? This is already awesome, right? There's so many great benefits here in this new bill. This is like a Christmas present that just, got signed into law today, 2 days after Christmas, but we'll take it a little late. Here's another one. There's an additional catch-up. So for 401k plans, and this is for you solo K owners too, you have a $6,500 catch-up that you can do if you're 50 or older, where they're increasing that for those 60 to 63. I don't know, whatever reason, it just hit that age of 60 to 63, you get an additional catch-up of $10,000. Now, this starts in 2025, but it's going to give more catch-up dollars and ability to contribute to those who are in older age, still working and contributing into their retirement account. And now this can be traditional or Roth, but actually, if you're high income, your catch-up contributions must be Roth. This is a new thing going through the bill. If the Congress is going to allow you to do catch-up contributions, meaning catch-up is if you're older, 50 or older, they're requiring you to make them as Roth. Now, high income is about $145,000 single. Rules are going to get defined on this more clearly, but just know catch-up might have to be Roth depending on your income level. But again, no big deal. Roth grows and comes out tax-free. We all love the Roth anyways. So now there are more changes in the bill that are awesome for any of you that self-direct your IRA or trying to save and maximize your planning to have a retirement you can actually look forward to. So this bill gives, again, more Roth options, delays RMD age, lets you put more Roth in a 401k if you want. There's so many great things in this. Please check out my article on it where I've got more details on this. Get over to mattsorensen.com and directedira.com, and we're going to be doing a podcast episode and much more content on the changes in this bill and how you can take advantage of them to help take control of your retirement.